Hey, what's going on? Zachary Jensen, managing partner at TaxWise Financial Services here, where we're empowering small business owners to maximize tax savings and grow with confidence. Today, I wanted to go over the top three real estate professional mistakes people make when they're qualifying for real estate professional. So, if you don't know what real estate professional status is, real estate professional allows you to take passive losses and turn them into active losses, and then we can offset W 2 income, and this is a very powerful strategy a lot of our clients are using to save tens of thousands, in some cases, hundreds of thousands of dollars. And while real estate professionals enjoy unique tax advantages, particularly when it comes to this and other rental activities, the IRS imposes really strict requirements, and missteps in meeting these requirements can result in disallowed deductions and costly audits. So, I wanted to make a video going over the top three mistakes we see people make when trying to qualify for real estate professional when they're coming over from other accountants that, let's say, don't have as much real estate experience as us. So, mistake number one is confusing two tests as one. So, one of the most significant errors taxpayers make is the misunderstanding that the qualification requirements for real estate professional status are actually two tests and not one test like they think. Many assume that meeting the 750-hour test alone is sufficient, but the IRS requires that we satisfy two different tests, and they're distinct. The 750-hour test is where the taxpayer must spend more than 750 hours in real property, trade, or business during the tax year. These activities include real estate development, construction, acquisition, conversion, rentals, operations, management, leasing, and brokerage. I wanted to read that off for you because those are the 11. There are no other ones. The second test is the material participation test. In addition to the 750 hours, you also need to materially participate in the rental activity itself. This is not a one size fits all requirement. Material participation can be demonstrated through one of 7 tests outlined by the IRS, but for most taxpayers, the applicable tests are spending more than 500 hours on rental activities during the tax year, or participating in at least 100 hours of the work done in the rental activity in more than anyone else. Failing to meet both of these tests leads to the classification of real estate activities as passive rather than active, which is what we want in the first place. The misunderstanding arises because the 750-hour rule applies broadly to all real estate trades and businesses, while the material participation test applies to each individual rental activity, unless the taxpayer elects to group them, which we will mention later, as a single activity. Taxpayers also need to maintain detailed contemporaneous records to substantiate their hours, including logs of the time spent on the property management, tenant interactions, and other qualifying activities. That leads us to mistake number two: poor record keeping and substantiation of hours. Another critical mistake is failing to maintain sufficient documentation to substantiate the hours spent on the qualified activities. The IRS scrutinizes claims of real estate professional status, especially for individuals who hold full time jobs outside of real estate. Without any credible evidence, taxpayers risk having their claims denied. The IRS does not mandate daily logs, but any time tracking must be reasonable. So you have to have support from additional evidence, such as receipts, invoices, appointments booked, emails. Common pitfalls include post evident estimations. So the court routinely rejects ballpark guesses made during audits or court proceedings. If you're going to go under audit and you don't have a time log and you try to reproduce it under audit, that's going to get thrown out just because the court knew you weren't keeping track of your time. The exaggerated or fabricated claims, right, suggesting exaggerated time logs, like, oh, I spent 20 hours mowing the lawn, not going to fly. Failing to differentiate between qualifying and non-qualifying activities. For most, commuting, investor-related research, and other passive activities like limited involvement in decision-making don't count towards the hour requirements if, and this is a key point, if they're by themselves. So if you mix that in with other qualified activities, then they usually substantiate pretty high. So to avoid these issues, taxpayers should maintain clear records detailing specific activities, times, and nature of the work performed. Using time tracking apps or just a simple spreadsheet, we can give you one for free, our clients use, can help create a robust defense in questioning by the IRS. And furthermore, taxpayers should be ensuring they distinguish real estate activities from personal or investment related tasks that don't qualify. That brings us to number three: neglecting to make the grouping election. So, for taxpayers with multiple rental properties, Failing to elect the grouping election for all properties, putting it into a single activity, can be a very costly oversight. By default, each rental property is treated as a separate activity, requiring the taxpayer to meet material participation tests, like the 500-hour rule, for example, for each property individually. So anyone managing more than one property finds that this becomes nearly impossible. So there is the grouping election that allows taxpayers to treat all rental properties as a single activity, and once they're grouped, the taxpayer only needs to meet material participation thresholds across the whole portfolio as a whole rather than each property individually. This reduces the administrative burden and makes qualifying as a real estate professional significantly more achievable and practical. So through making this grouping election, taxpayers must file a statement with their original tax return for the year they wish this election to take effect. The election remains in place for future years unless revoked due to a material change in circumstances. So missing this election means the IRS will assess each property separately, often resulting in the disqualification of rental losses. Additionally, failing to make this election can jeopardize a taxpayer's ability to qualify for real estate professional if the rental activities are spread thinly across multiple properties. For example, if a taxpayer owns 10 properties and spends 50 hours each, they fall short of meeting the 500-hour threshold for any individual property. However, with this grouping election, those 500 hours aggregate and they meet the election. So that's a good example. So in summary, real estate professional, it's a great thing for clients. People love it. It saves them tens of thousands of dollars, but you got to do it right. You got to work with someone that knows real estate. So if you think you're making any of these mistakes, I encourage you to reach out to us, or you're worried about potentially making them in the future, please reach out to us. We've been around since 2006 helping real estate investors with this very exact thing. So I hope you enjoyed this video. I hope you found it useful and helpful. If you like it, please check us out. Our links are in the description below, and we look forward to chatting soon. Thank you so much for watching, and have a great day.